One of the biggest stress that parents feel is mostly on the lines of how to invest for the child's future to ensure that they have the best education, the best marriage, whatever their goals are easily achieved. Can you relate to this? I bet you can. If you want to know the answer to this, listen to this video very, very carefully. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach, and I'm on the quest to help more than 1 million middle class Indians to not have to worry about planning for their finances, planning for their goals, to be able to live a life which is completely free of money worries so that they can truly follow their passion, follow their purpose, live a happy life. So, how is it that we can plan for their children's future goals, their dreams? How is it that we can invest today? How can we make all of this possible? Let's start talking about that. So let's assume that in the scenario number one, you have a child who's under the age of 10 years. So this could be a newborn up to the 10 years of age. I'm generalizing because the goals that you're going to have for your children are at least a decade apart, which is another 10 years from here. It could be a higher graduation, it could be a post graduation, it could be marriage, whatever that may come. It is at least close to 10 years away from this. So in a scenario like this, you should be thinking of investing for only long-term investments. Now, the problem that most of the people do here is that they go for old ways or traditional ways of investing. They would mostly invest in, if it's a young daughter, a Sukanya Samriddhi account, or they would invest in PPF, or they would invest in life insurances. The whole idea is that all of these insurance, most of them are debt-based investments, which means that they have fixed interest. Wherever there is an element of fixed interest, you are not going to be able to grow as much. Yes, it will give you safety and security, but no, it will not give you the growth. You might not even be able to beat the inflation. So you're at best around the same rate of inflation. So you're not really growing your money. You're only ensuring that the growth of your wealth is equal to the inflation rate. So the value of your money stays the same, realistically speaking. But you don't have to do that mistake. You should be thinking of investing into the stock markets. Now, when I say stock markets and investing for your child, a lot of people start panicking. But I'm not asking you to invest into shares. I'm not asking you to do futures and options trading. I'm not asking you to become a speculator. I'm asking you to follow the same philosophy that Warren Buffett used. What does he say? He says that simply invest into indexes. Indexes are like Nifty and Sensex in India. So if you keep on monthly investing into this, you historically have seen Sensex started in 1979. Today, it has breached 53,000 points. Can you believe that? How did this rise came? Because you simply keep on investing. You do not trade. You do not try to speculate. Just simply every month keep on investing. You have more than 10 years. That's 240 monthly installments to go. You don't have nothing to worry about. Markets go up, market goes down. Your monthly investments will average the return out. This is one amazing, simple, no-brainer way of actually doing it. Now, here is the second scenario. In case you have a child who is more than 10 years of age, now you don't have another 10 years to go, or you have less than 10 years to go, what are you going to do? So this is a very crucial time period which requires a better strategy. You can't just simply invest in the stock markets, because you need to come up with a better strategy which can even take care of the nearer term needs. So what should you do? You need to go for multi-asset investing. So which all multi-assets? You need to go for debt, equity and gold, all of these three. So equity, you anyways know why I suggested you. Why debt? Because if the debt element brings the stability and certainty in your portfolio so that you're able to make fixed returns out of this. Now, this debt should also be on the basis of what tax slab that you are into. This debt should also be on the basis of what net returns after paying the taxes and investment charges. That net return is the base fundamental. So not just the return of debt, you should also be looking at a very integral aspect. And what is that? That simply is the safety of this debt as well. Because just trying to make more returns but forgetting the safety and security of your capital could be an even bigger blunder. So ensure that you are investing in safe debt, tax efficient, and most importantly, this is able to bring stability in your portfolio. Equity, the strategy would be the same, keep on investing on a monthly basis. For the strategy of investing into debt, ideally should be lump sum, ideally should be your FDs that you convert out of your bank. Now, the third element is gold. Why should you invest in gold? See, the idea is that you might not allocate a lot of money to this, but you should still invest in gold, because this creates a hedge against equity in your portfolio. So this kind of ensures that a fall in the equity markets is likely supported by a gain in the price of the gold, especially when there is a big economic crisis happening. So this could be a great strategy of hedging your portfolio and creating a diversified asset alongside having debt, which ensures your returns are more stable, more than debt, but not as much as equity, somewhere in the middle, because you don't have enough time, or you might not have enough time, or you don't want a lot of volatility in this period. Now comes the third scenario, which is the hardest part. If your goal is very near and you don't have enough money, now what do you do? So even if you invest, you don't have enough time, or you might not have enough money. Now what are you going to do? Now this is the trickiest part. Any guesses what are you going to do? Well, don't worry. You don't have to guess. I will tell you what you need to do. So in a scenario like this, we need to go for educational loans. So in India, as per the Income Tax Act 80G, there is a very amazing taxation benefit that you get on 80G educational loans. So on this particular educational loan, the benefit that you get is that whatever interest part that you have to pay, let's say you take a loan of, let's say 50 lakh rupees. On 50 lakh, you have to pay 10% interest. Okay, this is the interest that is given to the financial company who is giving you this loan. So 5 lakh rupees every month is the interest component that you're paying, right? Now, this 5 lakh rupees is set off by the income that you are making every year. So in case, let's say you make 10 lakh rupees, let's just assume that, okay? So out of the 10 lakhs, you are paying tax on the full 10 lakhs as per the tax slabs, but 5 lakh rupees, the interest that you paid, and that will be set off by your income by 5 lakhs. So your net income will actually be only 5 lakh rupees, which means you're only paying tax on the 5 lakh rupees, which means what? That you've made 5 lakh rupees of your income completely tax free. And the amazing part is that you do not even have to set a limit on this. The absolutely no ceiling on the level of interest that you're paying, which can later be set off by your actual income. So in case you have a loan of 1 crore, you're paying 10% of that, that's 10 lakhs, and your income is also 10 lakhs, and you're paying no taxes to the government, at least in your personal ITR filing. This is the amazing benefit of an educational loan. See, the whole idea is achieving the goals. It could be through investing, it could be through taking loans. We do whatever we can do for our children. We want to do the very best, isn't it so? So my blessings, my wishes, and my best of luck with you, for you to achieve all of these things. If you still have any doubt in regards to any of these things, please don't forget to ask the wise guy. Hit me in the comments. Let me know if you have any questions. Share it with the people who you think can benefit. Don't forget to like this video. See you in the next video. God bless you.